Hey guys, it's Tyler. Hope you guys are doing well. I wanted to make a video for you guys. I wanted to actually make a video specifically for people in the Philippines. I'm actually a licensed advisor as well in the Philippines, and I've decided to take my career to my roots as a Filipino. I owe that to people there, and I owe it to myself to really help as much people as I can. That's why I decided to expand in the Philippines. So I wanted to show you guys, I'm with Manulife Philippines, so our head office is in Makati, but I'm based off of Quezon Avenue branch. So let's go into a product. It's called a VUL. It's called a Variable Universal Life. So what is a VUL, Tyler? A Variable Universal Life is basically, it has an insurance component and also has an investment component. The basics of the plan is that you want to have some insurance, but at the same time you want to have living benefits. Living benefits include obviously the investment components. So a part of the premium basically means the monthly or quarterly or annual payment that you pay. A portion of that payment is going towards insurance and investment. So over time, you can actually grow your contributions in the plan. So I made a quick illustration for you guys. Let's say the face amount, and my client's name is John Client for this illustration only. Let's say the face amount, so the death benefit, which basically means if something were to happen to you, your family gets 1,000,000 pesos in coverage. Now with this product here, it's actually very unique because this plan actually doubles the premium. It's called a VUL. It's like a DB2 benefit. But part of Manulife's product is they base the price on the original face amount, which is 1,000,000 pesos, but they actually give you 2,000,000 pesos. So they times to the face amount, they times to the death benefit. So you actually get double. For paying for 1,000,000, but you're actually getting 2,000,000. So you're getting a 2,000,000 coverage for the price of 1,000,000 coverage. So let's go to the illustration that I made. So as you can see here, Mr. John Klein, he's 38 years old and he has 2,000,000 in life insurance. He has 2,000,000 in accidental death benefits. So if something were to happen to him, by accident, he gets hit by a car, etc., he gets 2,000,000, and also a critical illness rider of 1,000,000. So in total, he has about 4,000,000 in life insurance. I just wanted to note that this amount, this accidental death benefit, if it's not accident, then this would only be the coverage. But if it is by accident, then it would be 4,000,000. With the enhanced critical illness rider, if you get sick, cancer, stroke, kidney disease, any of the 25 illnesses that this plan covers, you're eligible, and you're covered for 1,000,000 pesos. So if something were to happen to you, the insurance company Manulife would actually give you a lump sum benefit. So let's go to the very exciting part, which is I also wanted to mention the disability waiver. So if you were to get disabled, Manulife would actually pay for all your remaining premiums or your contributions in the plan, your investments. So let's say you're paying monthly, Manulife would, and you get disabled, Manulife would continue paying your monthly. So you wouldn't have to pay that anymore if you were to get disabled. So that's a very important feature. So let's go into the benefits illustrated. So let's say my client is 39 years old. The annual premium is 39,380, right? The unique thing about this plan is that you're only paying for 10 years. After 10 years, you're actually covered for life and you're not paying any more premiums. So let's do the math here. So I'll go to my calculator. So let's say you're paying 39,380 times 10 years. So that would be 393,800 pesos. As you can see, an estimated return of 10%, you actually get all your money back on the 10th year. Plus, it would be more than the actual contribution. So you're actually contributing 393,800 pesos. And your kita, your profit, plus your investment is 406,703. So if you were to do that, 406,703. So let's do this by negative 406,703. You actually still profit 12,903 pesos at the 10th year. And if you keep your plan going on longer, you can see your profit is increasing over term. At an estimated return of 10%. Obviously, it could be more or less depending on the market value or the markets and the companies that the fund is being invested in. So 4, 8, 10, it can even be 12, 13, 14, 15, 1, 2 negative returns. But for this illustration, 10%, you can see that you're not paying any more premiums, but you're still making profit as time goes on. So you can see it's a good retirement strategy because the earlier you start, the more you get in the long term. So it's very important to start early. So you can see, let's say the client wants to retire at, 73 years old. He only contributed how much? 393,800 in 10 years. But yung kikitain niya or yung profit niya plus the principal, which is his initial investment at age, let's say 73, is 3.6 million 796. So if we do the math there, 12796 minus 393,800, the profit is 3.2 million over the long term, starting from age 38. So you can do the math on that, 73 minus 38, how many years that is. So you can really see the long-term potential is really, really good, really good. And if something were to happen, let's say God forbid, the client gets into an accident, the family would get 4 million pesos in life insurance. So you can see the importance of having a plan early, because let's say, for example, you only contributed 393,800 over 10 years, but let's say the insured, the person who has the policy, God forbid he or she dies, the family gets 4 million pesos, and he or she only paid 393,800. So that's a huge amount return on your investment. And the thing to add there is, instead of having the family take the risk when the person dies, or let's say the breadwinner, let's say the mom or dad dies, the risk doesn't go into the surviving spouse. The risk is carried towards the insurance company, which is very important, because a lot of people, they don't get insurance, but when the breadwinner dies, let's say the mother or the father passes away, the insurance company should be the one to pay, not the family. Because if the family is paying upon death, first of all, where will the family get the money for the food, or for the shelter, for the mortgage, for the car loan, all the expenses that the breadwinner was taking on when he or she was alive? Now the surviving spouse, or the beneficiaries, whoever is left behind, is now responsible for taking care of that bill. And what if let's say, for example, the kids are still minors and they can't work? Let's say you have 3 or 4 kids, and there's only one breadwinner now. What about the income of the other spouse, or the other breadwinner, or the primary breadwinner before? That's why it's very important to make these plans early, so you can avoid all these hassle and bastles in the long term. So that's really what I wanted to talk about in this plan. I mean, there's obviously more things regarding this plan, but just to make things very easy to understand, I wanted to make it quite simple, although it was a little bit complex. But that's kind of the basis of how this plan works. Basically, to sum up again, it's an insurance with an investment. So a portion of that premium is going towards the insurance, and a portion of that premium is also going towards the investment. So you have best of both worlds. So I hope you guys learned a lot in this video presentation of me explaining a VUL. If you guys have any other questions, please feel free to comment down below or add me on my social media accounts. I'm going to be making a follow-up video with this plan, because it is a little bit complex. There are other things that are involved in this plan, so I will be talking about that in the next video. So I hope you guys enjoyed, and I'll see you in the next video. Take care, guys. Have a great day. Bye.